So the big tax question is this: how do wealthy people keep their money working for them when selling their business, real estate, or other highly appreciated assets without paying hundreds of thousands to millions of dollars in tax? What if we, as business and real estate owners who have poured blood, sweat, and tears to growing our wealth, and who didn't hire expensive tax attorneys and CPAs to map out an exit strategy, knew their secrets? Instead of recreating the wheel, why can't we just model the way they deferred 30 to 50% in tax, paid off debt, funded their next business dream, and most importantly, leave a financial legacy to give to the causes we believe in most? What if their secrets weren't complicated at all, and you just need a guide who is a few steps ahead of you? That is the question, and this podcast will give you the answers. My name is Brett Swarts, and welcome to Capital Gains Tax Solutions. Welcome to Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy is the best way to grow your wealth. I'm your host, Brett Swarts. Each episode, I'm joined by some of the best financial independents and passive income wealth advisors in the world, where they share their ideas, deal stories, and inspiration, so together we can make complex tax deferral strategies simple and passive income plans achievable. I'm excited about our next guest here. Many real estate investors, they really struggle with reducing capital gains tax, but also tax savings when it comes to owning commercial real estate or businesses. Our next guest is a cost segregation specialist, and together with his team at Madison SPECS, they help property and business owners save millions of dollars every single year. In fact, over the past 14 years, Madison SPECS and our guest has done over 15,000 cost segregation studies covering all 50 states, resulting in over $3 billion in tax savings. So please welcome with me, Yonah Weiss.
Thank you very much, Brett. It's a pleasure to be on the show, and happy to, be able to share some of my knowledge with your listeners.
Absolutely. We're looking forward to diving in. And by the way, you can learn more about Yonah. He also has his own podcast, which I'm going to have him just plug right now. But you can also learn more at madisonspecs.com. That's madisonspecs.com. And Yonah, what podcast are you on right now? You just launched one, I believe, right?
Just launched one a few weeks ago. We only actually have recorded one episode thus far, but it's called Higher Profits with Bobby and Yonah. And I'm actually in the process of launching another podcast on my own. I'm just getting some recordings done before actually launching, and that's called Weiss Advice. So that's going to be launching probably at the beginning of 2020.
Weiss Advice. I like that play on words there. It's like wisdom and Weiss and all wrapped into one there. So let's get started here. So will you give our listeners a little bit about your story and then your current focus?
So just a brief about my story. I actually have a background in teaching. I spent about close to 2 decades teaching various levels, all the way from literally kindergarten all the way up to post-collegiate levels. And I have 6 children, so every day is teaching, right? Every day is part of education. And that's really my passion, which for whatever reason led me to real estate about 5 years ago. When I started to learn everything there was about real estate, just fell in love with it and everything there was to do with it. And one thing led to another, really got involved as a brokerage in commercial mortgages, and literally kind of fell into this position with Madison Commercial Real Estate, the company I work for now, and Madison SPECS, the specific cost segregation division. And I found basically what I'm doing is just teaching about cost segregation. And I'm, the business director, so I'm able to, work on the business development and teach people about something that most people don't even know about. You're muted again.
Education. Yeah, you're in the business of educating and helping people out. You started out as a teacher, and now it's when it's real estate, and then in particular, cost segregation. So when you joined Madison Specs, did you join as you look? I want to be a cost segregation specialist, or how did that progression go? Where you actually said, okay, now I'm going to specialize and focus. What was that? What was that journey like?
So Madison Specs is one of the industry leaders in the United States for cost segregation. So we have a whole team of engineers and accountants who have been doing this for decades, and they're really the experts in the field. And I literally just wanted to soak up everything from them so that I could be able to give it over. And that's what I found is a lot of people don't, very few people, a very small percentage of people, and probably your listeners now also don't really understand cost segregation. And most people wonder, well, it's tax related, so it must be my accountant is taking care of this. And I'm sure you come across this quite often as well, Brett. And that's just unfortunately not the case. So to be able to educate people about something they can kind of take into their own hands, which is their taxes, which is really not their taxes, their income. Because in the end of the day, we're discussing income tax, which is, depreciation. Cost segregation is an income tax saving more than anything. It can save capital gains as well. But the main thing is income tax. So it's your income. People have this misconception that if I make income, I have to pay tax on it. And that's part of the, I would say, the corporate structure, that you get taxes deducted from your paycheck even before you see the money you made. And the truth is, with real estate, there's so many deductions that you can create that you can literally keep all of your income. And so it's really yours. And so again, not, God forbid, to say, don't pay your taxes if you're obligated, but just know that making money does not mean that you have to pay tax on it if you don't have that tax liability.
Yeah, and it makes me think of the traditional educational system where we sort of grow up thinking that there's one way to do things or only a couple ways to do things, and anything outside of that box can kind of really shatter the thought process of what it means to do something new, right? But the reality is that the government gives these legal tax loopholes to incentivize business growth, job growth, and the study of macroeconomics shows that when you do these things, they actually end up getting more tax revenue and more jobs created, more properties built, more businesses started, all of those things. So they actually want you to do this because it helps to bring in more. So it's actually a win-win-win. So backing up a little bit more, Yonah, before your success as an educator and what you're doing now, who are you growing up? And in particular, how did that what gifts were you given? Okay, what gifts were you given? And how did that shape how you help others today? So I want you to connect gifts that you were giving as a youngster, right? As growing up, adolescence, and then connecting now exactly what you're doing as an educator. And if for somehow you can connect the cost seg, that would be even more magical. But give us that idea of who you were growing up.
That's a great perspective, and I'm very grateful. I really grew up with a lot of gifts. And I think, a lot of us did. We take for granted, and, looking back, decades in the past to try to figure out, where did I come from? How did I become who I became? I think one of the gifts that I only really realized a little bit later in life, into I was about like 18, 19, 20 years old, I realized I had this really powerful gift of learning things. And I think that came with education. As I started to get into teaching, I realized, hey, I wasn't so great at school, so to speak, because I didn't necessarily like the subjects. I wasn't really into certain things, and maybe the teachers weren't the best. And there were certain subjects I'm sure all of us have excelled in more than others. But when I started teaching, I realized that, wow, I can really integrate this knowledge and give it over in a way to help other people understand. And that was something that I really tapped into. And I think that's one of my greatest gifts until today, which is I can learn something very new, even complicated, and integrate it very fast and be able to give it over in a simplified way. So I'm not going to get into too many other things of gifts, because there are so many. It's we could go on for hours, but I think that's, if I had to pull out one thing, that would be it.
Excellent. So if you found something that was interesting to you, then you could really dive in and learn about it, especially if it happened to be complex, and then once you were able to, break it down, understand it, inspire and educate others, that gave you more inspiration.
Exactly.
Excellent. No, that's great. Now, after helping countless investors, business owners, interviewing many financial advisors, and also being on lots of different shows, you get interviewed quite a bit on commercial real estate podcasts, and you speak at lots of events. What is the single best practice and or theme to implement for building real estate investing, or building your real estate portfolio and or just building wealth through real estate?
So your question, the single best practice for building real estate or building your portfolio that I found,
yes.
Being involved in the industry, establishing a strong team. A strong team, meaning, it's funny because I actually spoke with someone today, and this was almost a unique perspective. And this guy said that he's worked, with partners, and he only does deals on his own, only does deals on their own. And I found that, most of real estate is like a team effort. And so there are a lot of people can bring their talents and partner up with other people, through the humility of being able to recognize that, I can't do everything on my own, and we can actually do so much better together. And that's really the definition of synergy, right? Is that on my own, I can only do so much, but together we can do so much more. So I think that's the number one component.
Building a strong team. And I'm curious, how does Madison SPECS done that within the organization? And I don't know if you've applied it to your own personal portfolio of real estate investing. Any connections there?
Sure, absolutely. So, from our company perspective, we have a team of about 60 individuals. So we have a team of engineers, we have accountants, whole operations team, we have a sales team, and everyone kind of works together. Each person has their own job, and it really kind of flows. There's a lot of fluidity to keep. I mean, if you think about the operation we've done in 2019, we've done over 2,500 2,500 cost segregation studies this year alone, which is, pretty incredible if you think about the volume of doing that, especially if you understand what is involved in producing a cost segregation report. Reviewing it, we review it at least 4 times. So we have numerous accountants who are reviewing everything, making sure that everything is totally compliant. So yeah, there is definitely a team effort there. And I would say because of that team, the accountants, the executives who are so knowledgeable in the industry are open, all the time. If I have any questions about anything, I have anything's come up in the actual, process, they're right there available anytime. So in my own personal,
Yeah, go ahead.
Knowing your role, exactly. Yeah, no. So knowing your role and knowing what you can give and doing that to, the ultimate, like doing your part, putting it all effort in.
And then for your personal real estate holdings or investing with partners, what's your strategy there, and how have you implemented the team approach?
So similar. So I did a little bit of investing on my own, single family fix and flips a number of years ago, and that was with a partner, and it was great. So I really loved that because we each had different roles, in terms of the asset management, actual, on the grounds, versus I was more involved with the capital raising and involved with the kind of underwriting aspects of it. So that was beneficial to have someone else who could be involved in the day-to-day, on the ground, kind of boots on the ground, which I didn't like so much. And now, coming back full circle, I'm getting into investing in multifamily with some partners, and the same thing. I have people who are good at what they're good at, and each one of us can bring to the table something else.
Excellent, excellent. So now let's get to the practical part here. So we really want to help the listener understand what a cost segregation study is and how it actually can save taxes not only on the passive income, but active income. So maybe let's start with what's a cost segregation study? How does it defer taxes on, let's say, capital gains tax and or passive or active, all of them? Kind of segment each of that if you could, and maybe just actually do a live deal. Let's try to maybe do a deal that was, I don't know, the recent $4 million deal or recent $5 or $2 million. You pick one. Just do a live deal and let's walk through kind of how that worked.
Sure. So someone will purchase let's say any type of property can work for cost segregation, but let's take an apartment building. That's one of the most popular things people are investing in nowadays. Even before that, let me take a step back because maybe people don't understand what depreciation is, what cost segregation is. You may, but let me just describe that for one brief minute. That depreciation is a income tax deduction, which means you can write off the value of the building that you purchase. You can literally write off the entire value of that, less the land, which is a small amount, as a tax write-off. But you can't do it all at once. The IRS gave a lifespan for commercial properties of 39 years or residential and multifamily properties for 27 and a half years. So that means you can take the entire purchase price of that building, again, subtract a small amount for land value, and write that off literally for the next 27 and a half years. Take that $4 million building and you're looking at about $120,000 a year for 27 years of a tax deduction. That means immediately from your income tax, for your income, you immediately deduct that 120,000 and you're only taxed on the remaining amount. So that's what depreciation is. Cost segregation is a really cool way of depreciating the property that, according to the IRS rules, a lot of things in the property, in the building, depreciate on a faster life, meaning you can write the value of those assets off at a faster life, not just 27 years, but actually 5 years or 7 years or 15 years. And so cost segregation involves an engineer who is well-versed in the tax code to come into a property, take a site visit, and identify all of those tiny details, literally every tiny detail of what's in the property, from the carpeting to the cabinets, to fixtures, to appliances, furniture, window treatments, electrical outlets, etc. All of that stuff, come up with a valuation of those things, and then be able to take that tax write-off in the first 5 years or first 15 years earlier on and front load a bunch of those tax payments. So it's essentially creating larger tax deductions earlier in the ownership of the property. And
excellent. So it'd be like,
okay,
for the 120,000, instead of doing that once a year for 27 and a half years, you might have 400,000 or 500,000 in the first few years, and then it might be two or 300. It's essentially going to be the same number. You're just getting the time value of money because you're getting it all up front rather than having to wait again 27 and a half years to get that full benefit. Is that a good summary?
Correct. You're front loading a certain portion of that to take that benefit in the early years of the ownership. Correct.
Excellent. So let's walk through an actual scenario. So walk me through, so-and-so bought this property for this amount, and they could have had 120 per year, but instead they did our cost seg study and they had X. Can you give us kind of a deal that maybe you closed without sharing any names or any confidential stuff?
No, of course. Yeah, and I'll just give a example. Let's say you have your example, $4 million apartment building. Okay, let's say we allocate 15% to land. Okay, which is pretty, in most places in the United States. I wouldn't say everywhere, but a lot of places that's a pretty average number. So you're left with remaining, approximately, let's say 4 million. Approximately $3.4 million of depreciable basis. That means that amount you would have been able to take, again, $120,000 every year for 27 years to get to your $3.4 million write-off. Instead, an engineer will come in, and typically on this type of an apartment building, a garden-style apartment, will typically be around 20% will be allocated to 5-year property, meaning the engineer will come to the property, will take a site, visit, go into each unit type. So it actually doesn't have to go into every single unit, does not have to disturb all of your tenants. But according to the IRS rules for multifamily specifically, can just go into one of each unit layout type and use those findings to apply to the rest because they're usually the same. And all the common areas, walk the property perimeters, and find also the land improvements that depreciate on a 15-year schedule. So he's going to come back and take all those findings, pictures, right, notes, measurements, and prepare a report. He'll find typically around 20%, sometimes a little more, sometimes a little less. So we're talking about 20% of your $3.4 million is about $680,000 of extra depreciation. So you're already getting your $120,000 every year, okay? And then in the first 5 years, you're taking an extra $136,000 every single year of depreciation. And that's how the conservation works. So in the first 5 years, you're basically doubling or more than doubling your tax deductions. And with the new tax law of bonus depreciation, you can actually take the entire amount in year number one, which means you don't have to wait 5 years or 15 years to accelerate or front load, if you will, those tax deductions. You can literally front load the entire amount in year number one, which we're talking about taking that entire $680,000 deduction, as well as the 15-year property, which I didn't, describe in quite detail, but it's talking literally on a $4 million purchase, potentially $1 million of tax write-off in year number one.
So let's walk through that for a second. Let's imagine I'm a high net worth individual and I'm making $1 million a year in either my W-2 job, but I have some investment real estate, and let's assume I qualify as a real estate professional, right? I spend at least, I think it's 750 hours per year, and I'm probably a general partner. I'm actively owning and managing or operating this property. So walk us through, if I made $1 million, let's say on my W-2 job or collectively with real estate, are you saying that $1 million could offset and I would have a zero tax bill, or what am I missing there, Yonah?
Yeah, you're pretty much right on that. And so how it works is that if someone is a real estate professional, okay, they or their spouse, okay, it's either or, which is the great thing. You can be a high income earner and your spouse can be a real estate professional, meaning be materially involved in the real estate business in one form or another, and owning properties, especially if you're a general partner. You can take the depreciation deductions to not only offset the passive income, meaning the rental income, but then it carries over and can offset all of your active income as well. So yeah, if you are just a limited partner and you are not a real estate professional, so the depreciation deductions are limited to your passive income. That means income from rental income from this property or other properties as well, and that depreciation can offset that. But the real bang for the buck is when you're the real estate professional can literally knock off their entire tax liability.
Yeah, that is, those are one of the times where you say, wow, that sounds too good to be true, of which Yonah would say, we've done thousands of these. The tax law has been around for decades. We've saved millions and billions of dollars. So it does work, and but it does take a specialist like Yonah, Madison SPECS, walking you through that. Every circumstance is a little bit different, so you want to definitely connect with him for your individual circumstance, and also connect with your CPA and make sure everyone's working together as a team that you're taking care of. So next question, Yonah, would be this. Well, what if I only make 500,000, and I had this $1 million? Does that 500 roll over to the next year, or how does that work?
So that can be used if you're the real estate professional, or even if you're not, and you have more deductions than you have income, then that creates what's called a passive loss. And that is essentially a negative on your tax return, but it doesn't go away. So it carries forward with you in future years. And essentially it's like creating an imaginary bank account that passive loss gets stored in and carries forward into the future years. And so you can use that in next year to offset the income, or in the current year, if you were to have, and I guess this is really more connected to what your podcast is all about, potentially can use to be offset capital gains taxes as well. Which means if a person, has a sale of a property or has a capital gain, they can create the extra deductions and then use those to offset those gains.
Excellent. Now, nuanced question here. If I don't use it in that first year, let's say for my active income, that million, right? And instead I use 500 the next year, and it turns into passive carry forward loss, right? I think that's what it's covering. Do I forfeit using it for my W-2 income, and it has to only be real estate passive related? Or walk us through that. In other words, is it getting recharacterized? And if it is, does that mean I can't use it for my regular W-2 job?
If the person is a real estate professional, so it's going to carry forward and be used across the board as well.
Or their spouse.
If the person is, or their spouse. If it's not, if you are not a real estate professional, then it still will be only able to be used against the passive income.
Okay, great. So it doesn't necessarily recharacterize. If you're a real estate professional, it's going to stay that same. You can do it for active or passive, W-2 income or passive income moving forward. But if you don't have the real estate professional, then it's always just going to be for passive income, real estate investment, or would it be business income too? Or how does that break down if I'm self-employed and a business owner?
So only a passive income would be able to use that depreciation. So if you may have shares, or you may have ownership in a business, but aren't actively involved in it, so that would be considered passive income.
Perfect. Thanks for sharing that. Now, the next most obvious question I think our listeners would have is, what's the aftermath? In other words, when does this tax catch up with me, Yonah? Like, what's the exit plan? So walk us through what some of the strategies to not get hammered by the capital gains tax recapture or depreciation recapture. Walk us through navigating that.
Absolutely. So when you sell a property, you have, besides the capital gains tax, right? If you sell that property at a profit, you also have another tax, which is called Depreciation Recapture Tax, which means that you have to now pay a tax on the amount of depreciation that you took. Now, that might sound like, well, why would I want to accelerate and take a lot more depreciation right now when I'm just going to have to pay tax on it later? If I would have taken regular depreciation, I would pay less tax later on. So there's really a couple of strategies around that. And the main thing to understand here is that, like you mentioned earlier, Brett, the time value of money of what cost segregation does, which is keeping your money and using your money, not paying taxes today and worrying about the taxes I may have to pay in the future. So it's the time value that $1 today is worth more than $1 5 years from now. And again, it's your money in the first place. So there's no obligation to pay it now if you don't have to. That's kind of the backdrop of this. But the strategies that one can do is, number one, I'm sure most people are familiar with a 1031 exchange, which can further defer the capital gains tax on the sale of a property. And it also further defers the depreciation recapture tax as well. So that's one thing that you're not concerned about when you're selling a property about this depreciation recapture. The second strategy would be is something called the partial asset disposition. Now, when you dispose of a property, either by replacing it, putting in something new, right? Replacing your cabinets and putting in new cabinets, or selling a property, disposing of the entire property, you can actually, there's a tax form that allows, law in the tax code that allows you to allocate a lesser value to those items that have a shorter depreciation life, like exactly what we're doing with the cost segregation, is allocating and identifying all that personal property that has a value to it and depreciates on a 5-year schedule. Well, guess what? If, after a year you did the cost segregation and you identified your cabinets, and the cabinets have a value in this apartment complex of $50,000, let's say, okay, just throwing out a random number in our $4 million property. You replace those cabinets, you can write off the value of that, meaning this partial asset disposition allows you to say, I am no longer, that's no longer on the books of depreciation. And so it's gone. And I take that as a tax write-off, whatever value is left. And there's obviously less value to it in year number 1 or year number 4 or year number 5 than there is in the day that you bought it. Okay. Same thing when you sell a property. When you sell that property 5 years from now or more, and you've allocated from a tax perspective, it's been fully depreciated. It has no more tax value to it. So you can literally write it off and allocate a lesser value to that $50,000 cabinet. You can literally allocate $1,000 to that. And so the depreciation recapture tax on that is only going to be, the 25% on that $1,000 as opposed to the $50,000.
Okay, so there's a 1031 exchange, which you could just exchange and defer everything when you buy a bigger property, and you just maintain that deferral until and if you sell eventually and it recaptures. However, you can also do what's called a partial asset disposition, where you're going to allocate lesser value on certain portions of whatever you've accelerated over the years, such as cabinets. And if you do that correctly, you maybe only get hit with 25% of the recapture. Is that a fair summary?
No, probably much, much less than that. I would say literally, you can, depending on how long you hold the property for, but literally, 5% or 10% of that recapture.
Okay. And curious, for your clients, are most doing the 1031 strategy, or are they doing the partial, or what's partial asset disposition, or what's is it 50-50, 70-30? What percentage are doing which?
I can't really say what percentage are doing what. I do know that a lot of them are partnerships, and a lot of them are syndications. And so 1031 is a little more complicated when you're going down that route and not necessarily taking that into account, but a lot, and this is pretty much across the board strategy of the partial asset disposition. So I would say a large percentage do that. And in fact, the big four, I mean, this is not like some just crazy tax strategy. The big four, right? All of the tax, they all use this, meaning it's not something that is just like this crazy tax strategy. This is something that accountants who earn real estate know about and use this to lessen the burden. And some even do it after 1 year, meaning after 5 years, that 5-year asset, it's very easy to say and to claim that has no value. After 1 year, it would be much more aggressive to say that these cabinets after 1 year have no more value. But there are accounting firms that actually do that. So there's definitely what to work with.
I see. Right. So you may want to be, if you're on the conservative side, say, look, if it's 5 years for these cabinets, generally speaking, that's the useful life, then, or whatever component you're accelerating, you may not want to take it all in 1 year for the partial asset disposition. You may want to wait till 5, but there's some that will take it in 2, 3, 4, 5, just kind of depending on their level of risk that they want to test the IRS, if you will, right?
Exactly.
Excellent.
And some people are comfortable with that,
Yep. Absolutely. Now, what about for the 1031? For those who do the 1031, the cost basis travels, right? So this might be more of the individual investor who's not in the partnership, has done the cost segregation, and is continuing to do the 1031 exchange. But part of the 1031, when you sell or you take depreciation, either straight line or accelerate it, that's going to lower your basis, right? And eventually, if you own long enough, you may fully depreciate or take enough cost segregation. So then when you sell, the basis travels. So you walk through what the strategy might be there, because they say, well, Yonah, that's great. I took all this accelerated depreciation, but now I just bought a new property. My basis is so low, I don't see, I'm missing out on the advantage now.
Right. So correct. The basis travels with you when you buy a new property. So if you bought this property, this $4 million building in 2019, you're looking at, $3.4 million of depreciation. You're taking $120,000 every year. So after 4 years, right, after 5 years, right, you've taken $600,000. Your basis, let's call it, is going to be $2.8 million. Okay, that's what's generally going to happen. So if you sell that building, right, your basis is going to carry forward to the $2,800,000. So what's going to happen at that point? And again, the capital gains tax deferred depreciation capture is deferred. If you add more value to your new property, meaning if you don't just take those funds and buy a new property for what the gain is on the property, you can actually use more funds and keep adding funds to the new property, and those new funds get added to the basis. So yeah, you're going to take that 2.8 million that's going to carry over, and whatever you added to the new property is going to be added to that basis. So if you keep doing it that way, you will continually be building your base. Each new property will have the equity from the property that was relinquished, right? The downlink property, and going into the new property will have even higher value to it. And so the depreciation will continue to grow as well.
Excellent. Yeah. So the key would be, it does travel, but if you buy a bigger property, you're going to have more to write off. And or if you add improvements to that, that'll also increase your basis as well. Okay, excellent. No, these are very helpful. And this is obviously very detailed for the listeners, right? It's a complex strategy, but once each individual circumstance or each deal is laid out, it's just a mathematical equation of what you bought it for, what is your basis, how much improvements have you put in, how much depreciation have you taken so far, and then from there get the cost seg study. So what would be the next steps, Yonah? Someone says, look, I'm interested. How would one go about either getting an estimate from you or scheduling a cost segregation study?
So we have people usually reach out to us either when they're under contract buying a property or recently have acquired a property. So we'll run the numbers, meaning we'll actually have our engineers look at details of the property and tell you what your projected tax benefits would be. And so we do that as a complimentary service at no fee, no charge for that. And we will tell you how much it will actually cost to go ahead and do a full study. At that point, we'll send an engineer to the property if you decide to engage us, and or whatever. That's when usually about a 6 to 8 week process of preparing that study, getting all that done. We can definitely do it faster if necessary, but I wouldn't wait to the last minute, especially this time of year. People are starting to wake up and think about March 15th when I have to start filing. Now everyone's waking up and saying, oh, okay, I got to get the cost segregation study done in time so the report will be ready for my tax returns.
And would you mind sharing just a general estimate, for like, say, a $4 million deal, what might the cost to have that cost segregation study done?
So it's based on the scope of work involved and not on the tax savings, so it doesn't matter if it's a $4 million property or a $40 million property, the actual cost will be pretty much the same if the scope of work is the same. So apartment buildings generally run anywhere between about $4,000 to $6,000. That's our fees for apartment buildings. Other type of commercial properties, maybe more because there's more work involved, right? Office building, you have to go into every single suite, retail, etc. But very rarely do you find properties that, over a $10,000 cost. We're talking about massive commercial properties. And at that point, obviously the benefit greatly outweighs, and even on a $1 million property and up, it's almost a no-brainer, the amount of tax benefit that's involved for such a small service.
When would you tell someone, hey, don't do the cost segregation study, it's not in your benefit? Is there a deal size that's too small, or is there a time limit when they're going to be selling here in the near future, or they've owned it for too long? Walk us through where you would say, we'd love to do business with you, but we just don't recommend it given the cost and given your current circumstances.
Sure. So several scenarios. So number one, the cost, if it's under $500,000, is usually not going to be enough benefit there. I would say even before that, the first thing I ask is, well, do you need the extra tax deductions? Because just creating tax deductions that you're not going to be able to use doesn't really help anyone. So that's really the first step. So you have to look at everyone's individual situation, and that's really what we're most concerned about. But the actual property, what will produce the benefits, over $500,000 is certainly going to be a lot of benefit there. Over $1 million, like I said, it's almost a no-brainer. If you're holding it for any less than 2 years, okay, you're going to be playing with that money, right? You're going to be playing with it. You're going to have to pay the recapture tax, and the partial asset disposition is going to be a lot less. So you're going to be hit with that. So I'd say a flip, definitely not a good idea. Under 2 years, usually not a good idea. Holding for long term, usually yes, a good idea. If you've held a property, if you owned a property for a number of years and never knew about cost segregation, you can actually do this retroactively without having to amend any tax returns. You just fill a form. It's called 3115 form, which allows you to change the method of accounting, change the method of depreciation from the property. And so going back, even 5 years or even 10 years can be beneficial depending on the size and the value of the property. Great
overview. Thank you so much for sharing that. We're going to wind down here with just two quick questions. Now that you're educating, you're sharing the knowledge of cost segregation, helping people reduce taxes. How do the people that you work with, and when I mean work with, I don't necessarily mean Madison SPECS, but I mean kind of your outer team or your outer tribe, the people that you're helping out, the commercial real estate syndicators, maybe the financial advisors who have their own companies in their own space, but they're leaning on you and asking for your services to help their clients. How are they best leveraging what you do to grow their business?
I would say I'm like a real giver in a lot of ways. So I go out of my way to help connect people. I go out of my way to help people, and whether that's on social media. If you're not connected with me on LinkedIn, if you are, you know what I'm talking about. If you're not, it's a good idea, because I literally help promote other people all the time. I have a very large network, help connect people. So I think that's a lot of what I enjoy doing. The business comes. Thank God this is, for like a lot of people say, this is like a no-brainer. It's a very easy sell, because it's really just about understanding what it is. And they're like, okay, well, yeah, well, why wouldn't I do that? I don't want to pay tax. Okay, let's do it. So for me, it allows me the kind of freedom to be able to just help people in many other ways, which is something I love to do.
Love that. And our last question here: How do you stay centered in your values and keep from being discouraged? The current environment we're in, with either news or media or even challenges with different changing laws and a lot of moving parts. How do you personally kind of stay centered in your values and keep from becoming discouraged?
I'm actually a very religious person, and I study and I pray and I meditate every single day. And I have a big family. I spend a lot of time with them. I literally don't pay attention to politics or the news. I don't have a TV. I don't watch YouTube, unless it's like purely educational if I need to. And so I don't really get involved in all that kind of stuff. So I stay pretty centered, just from focusing on what my values and what I believe is important, kind of accompanying my religious community and lifestyle and beliefs. So I think it's a pretty easy question.
That's wonderful. Yeah, prayer, meditation, centered on your values. Keeping the noise out by keeping away from TV and different distractions. I think those are all great habits to practice. Well, Yonah, I want to thank you for being on our show and sharing your wisdom with our audience. And I want to thank our audience again for listening to another episode of Capital Gains Tax Solutions Podcast. As always, we really believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Hopefully listen to Yonah and connecting with him at Madison SPECS gives you another strategy or another tool to help you reduce, eliminate capital gains tax and also just income taxes as well. As always, we believe not having a clear plan is the enemy, but using a proven tax deferral strategy such as cost segregation is the best way to grow your wealth. We look forward to seeing you on the next episode. Thanks so much.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.